It's been a week of carnage in markets as the global COVID-19 pandemic has driven the biggest percentage fall in the S&P 500 since the 1987 crash. Over the last week, US equity markets have fallen by around 18%, European by 24%, and the ASX has fallen by 17%. Now, clearly, a number of factors have been present here. There are now 134,000 confirmed coronavirus cases around the world, and almost 5,000 deaths have been recorded due to the virus. Europe's seen the strongest growth in cases this last week, with close to 15,000 increase. However, cases in the US are set to rise materially in the weeks ahead, having increased by 1,200 over the last 5 days. Action to control the spread of the virus has had a potent impact on market sentiment. Sporting events around the world have either been cancelled or will be played without fans. Italy took the incredible steps of closing all shops except grocery stores and pharmacies. France has closed all schools and universities. And in a troubling address to the nation, Trump announced a Europe-US travel ban in a belated attempt to prevent the spread of what he called a foreign virus. Now, Trump was forced to clarify later that trade will in no way be affected by the restrictions after suggesting in his address that anything coming from Europe is what we're discussing. However, the damage was done and global equity markets went into a tailspin after his speech. Over and above the coronavirus, we've seen a crude oil price war break out between Russia and Saudi Arabia. At the OPEC and OPEC Plus meetings last week, markets had expected OPEC to announce an extension of the current production caps and also agree further cuts in the region of 750,000 barrels per day. There was no agreement to do anything last week from OPEC, and over the weekend, Saudis slashed crude prices and announced a sharp increase in production. Saudi production has averaged about 9.9 million barrels per day through Q4 last year. Yesterday, Saudi Aramco announced plans to increase production to 13 million barrels per day, while the UAE will take its production from 3 to 4 million barrels per day. In the face of a collapse in demand for crude due to travel restrictions and bans, an OPEC price war has had a huge impact on crude prices. From the high seen in January this year when Trump ordered the assassination of Iranian General Soleimani, the US benchmark West Texas has fallen by 50%. While this is good news for consumers, it's increased pressure on emerging market economies, high-yield debt markets, and obviously energy producers. Central banks have been quick to respond to the carnage in global markets. Over the last 2 weeks, we've seen an emergency 50 basis points cut from the Federal Reserve, 50 basis points from the Bank of England. The Bank of Canada has also cut by 50 basis points, and the RBA by 25. The ECB last night announced a new refinancing facility, a new targeted funding facility, and an additional €120 billion of asset purchases focused on the private sector. On top of this, the Bank of England and ECB relaxed capital and liquidity buffers to provide increased lending capabilities in these very troubled times. The Fed also last night threw trillions of dollars at funding markets. In the face of this enormous wave of liquidity, it is indeed concerning that global markets have fallen as much and as quickly as they have. As Lagarde emphasized very clearly at the ECB press conference last night, it should be up to governments to come up with an ambitious and collective fiscal response. And it's probably fair to argue that to date we've seen no real signs of collective response from G7 governments. Here in Australia, the government has announced a bold fiscal stimulus package to bolster the economy's defences against the damage that will be wrought by COVID-19. The stimulus package is valued at $22.9 billion over 3 years from 2019-20 to 22-23, representing 0.4% of GDP over this period. However, ahead of the announcement, Westpac's chief economist Bill Evans argued that Australia will enter a technical recession in the first half of 2020, and despite the government's bold efforts, the forecast has not changed. Now, next week sees regular policy meetings from the Fed and Bank of Japan on Wednesday and Thursday, and the Fed is fully priced to deliver another 75 basis point cut on top of the emergency 50 basis points seen last week. The Aussie dollar has made fresh post-GFC lows back to November 2008, close to 62 cents this week, and gains should be limited ahead of the RBA minutes due on Tuesday and the employment report on Thursday next week. These are all factors we'll talk about in next week's Markets Update.